Welcome to the Credit Clubhouse, where we take a weekly dive into the world of credit markets, alternative finance, and everything in between. Don't forget to follow the show, rate us, write a review, and share with friends. We're always open to guest or show ideas, so please feel free to reach out anytime. Just todd.anderson@DealCatalyst.io. I encourage you to check out the remainder of DealCatalyst's 2026 calendar, including ABF 2026, Fund Finance West moving to Vegas for the first time, and GPLP Secondaries, which is a new addition to the schedule. Listeners can get up to 10% off any ticket to any conference by using the promo code CREDIT at checkout. And now, on to our next episode. This episode is brought to you by Cardo AI, the operating system for asset-based finance and private credit. These markets still run on spreadsheets and siloed systems. Cardo AI brings everything into one system: the data, the structuring, the borrowing bases and waterfalls, the cash flow modeling and simulations, and the investor reporting. That's front office to back office, all in one place. Today, more than 700 facilities and $150 billion run on Cardo AI. The world's most sophisticated investors and lenders use Cardo AI, equipping their teams with a level of control and intelligence that legacy tools simply cannot match. See it for yourself. Talk to the experts at cardoai.com. Welcome back to the latest episode of the Credit Clubhouse. As always, I'm your host, Todd Anderson, head of content and programming at DealCatalyst. Joining me today is Connor Fitzgerald, a fixed income portfolio manager at Wellington Management. Connor, very appreciative of your time. Looking forward to our conversation.
Definitely. Thanks for having us on the podcast today.
So, for those who might not be as in tune with fixed income markets, how would you describe today's corporate credit environment? And then, while answering, maybe, is there a specific or defining characteristic of today's market?
Yeah, sure. So I'm actually going to take us back to 2022 and tell a little bit of a story, and walk through how we got here, and I think what's important going forward. So I think if you go back to 2022, obviously the Fed raised rates significantly, got off zero for what felt like the first time in 10 or 15 years. That was a big shock to the system. And so I think the reaction that we had from corporate issuers and companies in general coming out of that period was that given much higher borrowing costs than they had faced in the prior 10 or 15 years, plus uncertainty about the trajectory of the economy as the Fed battled inflation. And then as we moved into 23, we had, regional bank issues with the Silicon Valley Bank period, Credit Suisse over in Europe. 24, you had a lot of policy uncertainty going into the election. And all that's to say that we've basically had these like mini rolling crises with much higher rates, which conspired to basically incentivize corporates not to issue very much debt. And so then you move into 25, you have the Liberation Day policy shock, and that kind of takes us to where we are today in 26. I think the most important thing that's happening, which should come as no surprise, is really just the AI super cycle and how that's being funded. And so if you were to look at the past couple years, the investment grade credit market has grown a couple percent year over year in terms of size. And you can think of that as sort of like a net issuance calculation in a way. This year, I think we're expecting to do close to $2 trillion of gross issuance and probably close to $1 trillion of net issuance when all is said and done. I think a normal year in investment grade is more like 300 or 400 billion, call it. And I think that's really important because this higher yield environment that we've had has translated to lower supply and lower debt issuance. And that's a big reason for corporate spreads staying tighter, in our opinion. We think that's now changing because a significant percentage of the AI supercycle build out is being funded in the investment grade credit corporate markets. Coming into this year, we thought there would be about 400 billion from the big five hyperscalers alone. That number, I think, that estimate's probably pushed up closer to 500. And then there's a lot of financing associated with data centers that are related to the hyperscalers, but again, net new issuance. So we think we're in the middle of sort of a pretty significant regime change here, where we're moving from like an undersupplied corporate credit environment to potentially an oversupplied corporate credit environment, and that's happening at a time when credit spreads or borrowing costs relative to the risk-free rate are near the narrowest levels that they've been in history, certainly in my career. So I think that's sort of the defining moment of the defining characteristic, if you want to call it that, of the corporate credit markets today.
If you kind of look across investment grade credit today, I mean, it sounds like you might have referenced it in your answer there, but where do you see the biggest disconnect between pricing and kind of typical fundamentals?
I think the biggest disconnect that we've debated internally in the past couple of weeks, I think, is that if you take one of these very high quality hyperscalers and you look at where their long dated credit spreads are trading, in some cases these companies are rated single A or double A, and they're trading at a significant discount to the market, despite having arguably much better fundamentals today, like the spot fundamentals today, whether you look at free cash flow, net leverage, cash on balance sheet, et cetera, they look extremely high quality relative to the rest of the market, yet they're trading at a big discount. The reason that's the case is because the path of credit quality is expected to deteriorate a little bit on the margin over time. But more importantly, we expect them to be almost serial issuers the way banks have in the past, where certainly every year, but potentially every quarter, you're going to get another 15 or 20 billion in debt from XYZ company, and the market's basically pricing in a big discount to fund the incessant new issue, if you want to call it that. The rest of the market is still trading pretty healthy, but at some point, if there's too significant of a discount to supply and somebody has to fund a new supply purchase in a name like that, they might look to sell something else. And so the question we're debating internally is like, would you rather own these high quality hyperscalers at a discount, or would you rather own the rest of the market, which is arguably less good quality, but we know they're not going to create as many bonds over the next 1, 2, 3 years, and sort of a technicals versus fundamentals debate. But to be fair, it's a bit of like, what's the first derivative of change of fundamentals as well.
So if we we'll come back to the AI build out in a little bit, but obviously you referenced within your first couple answers there rates and kind of where the policy has been, and it's seemingly low, then high, low, and then I don't know what's going to happen the rest of this year. But
Yeah.
how much influence does Fed policy still have over credit markets versus company specific fundamentals?
I would say for the first 10 or 15 years of my career, which really started on the doorstep of the GFC, I think the market was overly obsessed with the Fed and hung on every word that they said.
Mm-hmm.
I think today, obviously the Fed is still really important, but I would say two things. One, I almost think paying attention to what's happening with fiscal policy is equally, if not potentially more important than the Fed. I think that was one of the things the market and myself for sure as well, maybe overlooked or underappreciated in 22. While the Fed was hiking, hundreds of basis points, we were also running 7, 8, 10% deficits into a full capacity, full employment economy. There's not a lot of precedent for us to have a recession in the US when you're running that easy of a fiscal stance from the government. And then the second thing is that I do think company fundamentals matter. I think the big structural themes in the economy are potentially more important than the Fed. And obviously AI would be in that bucket. But we've also had periods in the past where, something like the shale energy cycle in 2012 to 2016 was a big defining feature of the US economy, which I think helped us outperform other, global developed economies. But it also sort of created a credit cycle in investment grade and high yield credit markets. So we're definitely cognizant of what the Fed, the path that the Fed is pursuing, but We try not to hang on, like, we're not in the game of trying to predict what a 25 basis point tweak to policy rates means, because frankly, I just don't think it's that significant to the economy. And I think the final point I'd say is that, for the larger, like for the S&P 500 and for the upper wealth cohort in this country, there's very little sensitivity to short end rates. Most long-term corporates have termed out debt. They don't have a lot of commercial paper, for example. And then even the U.S. household in aggregate, has very low sensitivity to short end rates, because 70% of Americans or something like that have a 30-year fix that's below 4.5%, call it. So we're not as focused on the Fed as maybe we were in the past. However, if the Fed came out and said, like, we're really going to have a go at getting inflation back to 2, I think that would be significant. But I think for now, they're sort of like a passenger they're not necessarily in the driver's seat. I would say fiscal policy and then this AI build out is two much more important topics than what the Fed's doing for the next 12 to 24 months.
It was funny because you stole part of my next question, which was, if they, kind of ease more aggressively or delay cuts altogether, like, is there a scenario that the Fed can take that would create or what scenario, maybe to rephrase it, what scenario would create the biggest challenge for corporate credit investors?
I think if the Fed came out and really leaned against, like, above target inflation, above trend growth, and it was perceived that part of the reason they were doing that was because there was a little bit of, like, excess speculation in the artificial intelligence trade, like across the entire ecosystem, just given where valuations are, again, up and down the whole food chain. I think that could spark sort of a market correction and could potentially portend a bumpy period for credit spreads. So that would be more of a short-term headwind. But I think over the medium to longer term, I think the riskier play would be to cut policy rates, against higher inflation, against above trend growth, against easy fiscal policy, because then I think you risk sort of like unanchoring inflation expectations and potentially the long end of the treasury curve. And I think that's a much more concerning environment for fixed income investors, because really the scenarios where credit has just really bumpy periods are, one, a recession, or two, when there's heavy outflows from fixed income. And outflows sometimes follow periods of negative total returns. That's what happened in 2022. We don't think another 2022 repeat where the ag is down 10 or 15% is very likely. But I do think there's a case that if, like, long dated yields moved up significantly and total returns were highly negative, that could create sort of a negative feedback loop in U.S. Treasuries. And I think that would be much more damaging for credit markets overall, because you would have risk-free yields at levels that historically, if, say, rates went up another 100 basis points, I think that would actually force capital, like, out of riskier parts of the credit markets, because you could earn 5, 6, maybe even more percent, depending on what part of the curve you're looking at in Treasuries. And that would create, like, a crowding out effect, in my opinion, that would be pretty destabilizing for risk assets across the board. Like, said another way, I don't think the stock market's going to do too well if 10s are quickly at 5.5 or 6%. And I think the only way you get there is sort of irresponsible Fed policy with respect to inflation.
Got it. In terms of the biggest drivers of bond yields today, what are those? And as a secondary question, I know we've kind of touched on some of the, but where do you see the greatest opportunity today along the yield curve?
So I think that the narrative in the market around inflation is something that I appreciate, but I think that I'm actually coming at the bond market from a little bit different angle. I think the biggest story is that you have these, like, two massive capital vortexes in the U.S. deficit and then the AI super cycle build out that are basically, like, sucking in capital from all parts of the globe and all parts of the economy to fund it. And so when you look at the rise in interest rates year to date, it's actually been, and this is proxied by the break even or the TIPS, the Treasury Inflation Protected Security Market. It's actually been more of like a real rate move than it has been inflation. Inflation is over the medium to longer term, market implied is not at precipitously different levels than it was to start the year. Some of the shorter term inflation measures have moved up a bit through the Iran situation, but it's really been like a real yield led move. So I think that's what you should expect when there's large deficits and a big capital cycle and very strong growth in the US. And so to me, like what we're watching is like, how does growth pan out over the next 12 to 24 months as fiscal fades? We're making the assumption that they won't pass another big, beautiful bill there. And then we want to see if
especially in an election year.
Especially in an election year. And we actually think that's quite important. I don't have any prediction power on what's going to happen in politics, but there's a lot of precedent for losing at the midterms and having a little bit of a lame duck versus having, the Senate, the House, and the presidency to be able to pass whatever you want. And it all else equal, fiscal should actually be a headwind to start next year if we don't pass more. So I kind of want to see how the economy behaves when that's the case. And then I do think that there's a risk that the AI build out slows down. It's probably not a base case, but it's given how frothy it is, it won't take much from there. So I think the deficit and the pace of the AI build out, which to be just to make sure we're clear on this point, and I think there's actually a Fed paper that supported this. We've come up with around 40 to 45% of growth in the US is being driven by this AI trade. I don't know how significant that is in the halls of history. My guess is that it's pretty significant. And obviously you can always pull out the engine of growth from this dynamic US economy we're fortunate to live in, and say that the rest of the economy is weak. But I don't think that's totally fair. But it does strike me as that, and fiscal strike me as the major swing factor for the level of growth in the economy today.
I mean, how much, just as an aside, or I guess a follow-up to that, I mean, how much can it distort maybe other areas of the market if it's so much is focused on the AI build-out?
I think it can distort other areas. I think what we see under the hood, we were looking at a couple charts this weekend. What you see under the hood in the equity market is basically like a vicious rotation out of some of these AI beneficiaries that have done really well, and then moving into other names that are sort of less exposed. And I actually think that rhymes really well with what we're seeing in the corporate credit markets. We had some of the highly AI exposed names underperform pretty dramatically last week, but the credit market barely budged, which kind of means everything else was a little bit tighter. And those names were, pretty significantly wider over the last few weeks. So I think there's a bit of a rotation trade into more defensive names. But over the short to medium term, if those names continue to underperform, I would think it sort of starts like a chain reaction down the food chain. If the hyperscalers underperform, then the picks and shovels underperform. And then you're just talking about mark to market losses and pain across the system that could create a little bit of a deleveraging event and some volatility in markets. But we're not quite there yet, but that's definitely something we're sort of on the lookout for.
Before we dig right into the AI piece a bit further, is today's market accurately reflecting risk?
I don't believe corporate credit spreads are accurately reflecting risk. I think there's this almost religion-like confidence in spreads can't widen with yields at quote unquote higher levels. Mm-hmm. I think that the implicit assumption there is that corporate issuance will skew lower at higher yields. But I think we're seeing a really obvious source of significant supply that tells me that's going to be a little bit different over the next 2 years than it was over the past 2 years. So we think credit spreads, particularly in investment grade credit, are exceedingly tight. We would prefer to own shorter maturity securities in general across investment grade, but also other sectors like securitized and high yields, where we think the economy is fine per se, but we still want to keep our sensitivity to spread widening in portfolios at pretty minimal levels. But in general, given the full range of outcomes that you can envision over the next 1 to 2 years, I just don't think you're getting compensated that much for credit risk today.
I'm going to ask this next question maybe differently than I phrased it initially, but
Yeah.
when it comes to maybe other industries and compelling opportunities, do you think, given the AI build out, and we'll talk about that in a bit more in a minute, can other industries maybe find or see opportunities maybe come to light because so much energy and capital is going to AI that other opportunities maybe just come to the fore a bit differently, or trying to say like maybe
Yeah.
like are like a byproduct of so much capital going one direction, does other opportunities open up in the other direction with things that are not obviously AI focused?
Yeah, definitely. I think I'll try to give a couple examples. So so first of all, in credit, like it's hard to imagine a scenario where you can make a lot of money from spread tightening, just given the starting point.
Yeah.
However, I think in the next 2 years, we'll go through sort of a reset in credit spreads, either because there's some systemic event associated with an economic slowdown, or because there's just like an excessive amount of idiosyncratic risk. We are seeing M&A pick up. We're seeing debt-funded share buybacks pick up. To your point, there's obviously a lot of change with AI. So we think that will create opportunities. Like I'm thinking out loud, you could have healthcare companies that are able to leverage AI to solve problems that we've been trying to solve for the last 50 to 75 years. And that might entail, paying up for bolt-on acquisitions, and that would create an opportunity for us to help finance that in the debt markets. So I think there's going to be things like that. I would say in the high yield credit markets, like if we do have a bit of like crowding out and, capital is needing to flow up to investment grade to fund this massive supply, I'd say industries that are sort of like on the margin and having a tough structural growth, some tough structural growth. I'm thinking about things like building products, potentially, insurance brokers, where there's sort of like there are some headwinds from AI. Obviously you could put software in that bucket, where not every software company is going to benefit from what is happening in AI, but I think there's still a lot of software companies that have maybe more staying power than you would appreciate if you just see that software is on the name of the door of the company. So I do think there's opportunity to pick credits, but I think it's pretty idiosyncratic. I don't think there's like one sector that I have in my head that the market's ignoring that we should pile into or anything like that. And then the last one I would say that we're trying to think about what it means going forward is like, one of the things I'm trying to describe is I think there's going to be just a ton of like financial asset supply created, both in equity and debt markets. We're obviously seeing some IPOs. We're seeing equity issuance from the big hyperscalers. I expect that to continue. That's a real boon for banks and capital markets and investment banking. So I think some of the investment banking revenues, have more recently and can continue to be off the charts for some of the public investment banks, frankly. And I think those are pretty good opportunities as well.
So if we look at the AI infrastructure issuance, and obviously that's been a key driver of investment grade supply and is expected to increase, is that starting to change the way that you guys think about sector allocation?
I don't think it's changing the way we think about sector allocation per se, but here at Wellington, we take pride in our ability to collaborate across like different sectors, different parts of the firm. And so if you looked at some of these data center deals in investment grade, they do feel a little bit like a corporate bond, a little bit like an asset-backed security. So we've been doing roundtables that would include like asset-backed security analysts and portfolio managers, corporate credit specialists, and trying to really understand like the nitty-gritty terms of how these bonds work. We expect the issuers to continue to want them to look and feel more like an investment grade bond, just because the liquidity is so much deeper in IG, which is why I think there's arguably more headwinds in investment grade credit. It's just the only market where you can show up and issue 10 billion in a day at a pretty decent price. You just don't have that type of liquidity in high yield or securitized. So we haven't yet like changed the sector allocation per se, but we are really trying to understand these bonds, because they're just not your typical, not unsecured investment grade corporate bond. There's callability, call windows. There's security packages. There's lease payments that are funding part of the build out. There's construction risk, and there's all just certain terms that whoever would be the end tenant. We've just found there's a lot of dispersion across those terms. So we're sort of treating each one of these deals as like their own unique animal. We've passed on a couple of them, and we've been pretty large participants in a couple others. Frankly, I expect that the market will eventually coalesce around what almost like a standard-ish set of terms is. But we're still working our way towards there, and we still think there's some opportunity to pick and choose there.
I mean, as part of the complexity here is like, and I've talked to others about the AI, boom as well. And it's like part of it's real estate, part of it's this, part of it's a different, it feels like it's like 5 different things that kind of merge into AI. And is that part of that makes it so complicated, also at the same time so attractive?
I think so. I mean, I think it's hard. There's days when I wish we've actually had some portfolio manager meetings where we set a rule where we couldn't talk about AI because it feels like it's all we talk about. Somebody had to come with some new topics. And I think in the last 5 minutes of the meeting, it inevitably came up. But
Yeah.
it is truly ubiquitous. And it's so big that like the big AI trade literally has to fill like certain amount of issuance in like every pocket of demand it can possibly find, because it is that large and it is so important to the overall US economy. So, I mean, we're doing our own work internally to try to like understand like how much debt issuance across all the sectors is coming from things that are directly or tangentially related to AI. There's been some, and obviously it's a moving target. There's been some investment banks that have done the same thing in their research departments. And I mean, it's like trillions of dollars, as I'm sure you know.
Yeah.
So what we're trying to do is just be really careful that like in our securitized allocation and then our credit allocation, then our high yield credit allocation, that we don't have like highly correlated exposures that are all kind of the same trade. So we want to make sure sort of like the top down portfolio management risk process is robust enough where we know like exactly how much risk we have like in the AI trade, and then understand like where we are in the capital structure, what type of security we have, what type of spread duration we have, all sorts of things like that. But I think that's probably something that a lot of other people that are in the same seat as me are starting to work on. Simply because investment grade credit, for example, you have some of these issuers potentially bumping up against like issuer caps for benchmark relative portfolios, where like a client might say you can't own more than X% of a portfolio on one name. If you play out what most folks expect, what consensus expects to happen, we're going to start hitting those caps. And those aren't even inclusive of like, a data center that is backed by one of those names' lease payments. So we're trying to be in front of that. It's not rocket science, but it's more just like rolling up your sleeve and making sure you know what you own.
When it comes to, kind of risks where are the biggest risks in this trade, at least from your seat? I mean, I would think, obviously trillions of dollars, and then you get the other risk of like AI and those who are then claiming they're doing something in AI, which can kind of throw off, because once you start get something of this magnitude, it feels like everybody wants to do something AI related. But it's like those that are true AI and those that are kind of claiming to be AI. But I mean, where do you see the biggest risks in this giant build out that we're just starting to really ramp up and go through?
So I always try to think about like the super left and the super right tail outcome, because I just find that credit markets tend to be pretty boring, and then they're very exciting, and there's a lot of money that's lost or made in a short period of time. So I always try to think about like the wide ends of the distribution. The thing that I think is so unique about this AI build out is like, let's just say I don't even know if you'd call this a blue sky scenario, but let's say it works and it's everything that everyone hopes it could be. I mean, it is this phenomenal technology where, one person could potentially be doing the work of 50 people a couple of years from now. And we just try to think about like, what does that mean for labor displacement in the US? And not just losing jobs, but like the bargaining power of labor. What does it mean for the federal government potentially having to support with transfer payments a large cohort of the population as they're retrained and sort of pivot from one job to another? I tend to think that that's pretty deflationary. I think technology has always been disinflationary, if not deflationary, by way of like major productivity enhancements. The challenge on that theme today, I would say, is that, and I've joked as it like it's the economists versus the analysts in our internal debate. So the economists don't really see any like true data that would support that there's major job losses from AI. However, when our corporate equity or credit analysts talk to companies, like the consistent message we hear from companies is like almost to the company is that we can do more with the same, or we want to do more with less in terms of headcount and employees. Like we've heard companies literally say, we want to grow our profits by 50% and keep our headcount flat. I think that's just such like a negatively skewed labor market over the next couple of years that it's worth paying attention to. So that's sort of like one outcome that I think would be quite disinflationary until the government had to really step in. So that's a little bit more like pie in the sky down the line. And then I would say that the negative scenario that we're trying to think about is like, let's say all these LLMs become commoditized, which I don't think is crazy. That's kind of like in general what capital cycles do. They push things down to the marginal cost. And the efficiency and speed gains that we're seeing with these things are like incredible how fast, like said another way, like someone like myself doesn't need the leading edge LLM because I'm not using it to do like high flying coding. And so over time, I think the cost of AI is going to come down. And I think that the quantity will obviously go up, but that would create like a bit of disinflation on that regard as well. And then you also have to ask yourself, like, are all these companies that are valued at like just very, very large numbers? I'm not necessarily going to say the valuations are insane, but just huge dollar amounts.
Yeah.
If we have all this debt and equity issued and built up against those asset values, and then we learn that one, like the technology is cheaper and not worth as much, and two, maybe companies don't adopt AI at the pace we think, and maybe we don't harvest those same productivity benefits that everybody thinks we will. Like that's a true credit or capital cycle. And I think both of those outcomes are pretty deflationary. However, in the meantime, we're facing this like inflationary surge because we're going from like one bottleneck to another in terms of the things that you need to do the build out, whether it's the picks and shovels, the actual commodity inputs, the labor inputs, the land, the electricity, et cetera. But on the back end, I think the two extreme outcomes present pretty disinflationary risk to the economy.
Well, last question on the AI piece. Kind of if you're looking ahead, how do you expect these issuers to evolve within investment grade portfolios?
I think technology will continue to grow. I don't think that's a hot take per se. I think the bigger question to us is there a level of yields or borrowing costs where they would slow down the CapEx spend and or potentially move some of that capital raising into the equity market? It's just today, as it stands today, the assumed return on invested capital for these projects is like 25, 30%. So borrowing at 5, 6, 7, 8% is still, economically attractive to them, arguably. It just becomes a question of like how much do they care about their relationship with the credit markets. I don't think we're near that point yet, but I'd say another 100 basis points I think would be where that would start to enter the conversation. But I think they're going to keep going, I think is my simple down the middle answer. I just think they've kind of decided this is what they need to do. It's a bit of an arms race. The capital's still not super expensive relative to history. It's just kind of expensive relative to maybe like 2010 to 2020 when rates were really low. And these companies still have incredibly strong balance sheets at the end of the day. So I just expect tech and anything related to AI to continue to grow to be a much larger share of the investment grade credit index, particularly in the longer dated parts of the maturity spectrum.
Few more questions before we have some fun questions and begin to
Sure.
wrap up. If we look, say, the next year or two, are there any particular developments that could have, or do you think would have the biggest impact on corporate credit markets over the next, say, year or two? Does it come back to AI?
Yeah. Yeah, I mean, I would say if for whatever reason interest, like risk-free interest rates, moved a lot higher with spreads, even with spreads where they are today, I do think capital becomes, I think the key theme that we're trying to share a little bit of is like these two forces are making capital expensive for everyone else and kind of pulling capital from everyone else. So almost what I expect to see is like sort of like a rot that sort of like creeps its way up from the bottom of the risk spectrum towards the top. And the question is like, when is that big enough that it becomes a problem? So that's one thing we're sort of monitoring and watching. I do think this is a bit of like a, thing that could come out of left field, but, probably not likely. There have been periods in our country's history where Washington got religion on the deficit. I think about a period like 2010 to 2014 when the Tea Party, which seems like a bad dream at this point, really prevented Obama from spending any more money, and the deficit magically healed. And that was sort of a drag on the economy. And I tend to believe that was actually a bit of why like the secular stagnation theme creeped in. Like if you have a weak government and fiscal impulse, that's a headwind to the economy. So that's something we're watching very closely, because I think the narrative today is just that like it doesn't matter if you're a Democrat or Republican, you're just going to spend more money either by cutting taxes or just spending more money. So that's definitely something we're watching. And then I think the situation in the Middle East, not an expert there. I'm surprised with how long it's dragged on that there isn't a little bit more stress across the globe in terms of like literally able to get barrels of oil to places that, aren't as fortunate enough of a position as the US, where we have our own domestic energy supply. But I think like sort of the combination of Iran, green energy transition, and then also just like this huge demand for power and electricity associated with AI. I mean, generation growth in the US is growing a couple percent a year after being basically zero for the 2010 to 2020 decade. I think that's a really important topic to watch. And those bottlenecks that's a very like finely balanced market that can change on a dime, as we learned with Iran. So those are sort of the three things that the big like macro topics that I'm watching, in addition to AI, and somehow AI finds its way into all three of those again.
And is there a final question before some fun ones? Is there a consensus market view that you believe investors are underestimating or even perhaps just getting wrong?
I do find this consensus. I think there's a big consensus that like the US economy is highly durable and that there's very low risk of recession. I'm sort of a history doesn't repeat itself, but it rhymes. And I think there's a number of like disinflationary headwinds and frankly growth headwinds accumulating on the horizon. So I'm just more open to the fact that like growth in the US could potentially be weaker than folks anticipate today in the market for the next like 1 to 2 year, in the next 1 to 2 year horizon, I should say. But I don't have a ton of pushback on that's. More of like a lower probability, but something we're watching just given the skew in pricing. Honestly, my biggest pushback is just how tight investment grade credit spreads are. And we've gotten questions from clients like, why haven't spreads widened yet? I just think we're sort of like inning 2 or 3 of this massive supply wave. And I think sometimes it takes a little bit of time to break to like buy the dip mentality. And once that changes, where people think they can buy credit cheaper a month, 2 months, 3 months from now, like then things can start to move pretty quick. But that's probably the thing I have the most disagreement with is just the general level of credit spreads.
So a couple of fun questions. A favorite sports team and or hobby?
Favorite sports team is probably the New England Patriots.
I'm not sure if we can be friends anymore.
I'm
a Bills
not
fan,
as much
so
anymore.
that's.
Well, I like the Bills. I like Josh Allen. I would say favorite hobby is really just anything outside, riding bikes, golfing. I'm not very good at golf, but just trying to be outside since I sit in a chair for 10 hours a day.
Yeah. One surprising thing about yourself?
I'm a twin, still live in my hometown near all my family and friends from growing up.
Interesting. One book that you'd recommend reading?
George Soros' Alchemy of Finance. I've read it multiple times since the first time I read it. It's still just as good every time I go through it.
Most exciting part of your job?
I think the most exciting part of this job is just the ability to think creatively, work with people, and come up with like a unique, differentiated thesis or viewpoint, and then go back to your desk and put it in the portfolio and watch how it does. I mean, that's the thing I like most about this job is just staying intellectually stimulated every day, constantly learning, constantly having to adapt, but also like keeping score and being able to challenge yourself every day.
Then final question, I usually ask a different one. I'm going to ask a different one to you, which is, what's a bigger risk for the AI build out? Is it the cost of capital or the resource needed, whether it be power or water, is the biggest? Which one of those are a bigger two risk?
I think it will be the cost of capital.
Okay. Well, on that, thank you very much, Connor. I appreciate your time and, really appreciate you spending a few minutes with us here. Continued success to you and the team at Wellington.
Thanks for the opportunity. Appreciate it.
Yep. Thank you. Thank you for listening to the Credit Clubhouse podcast. Credit Clubhouse is brought to you by DealCatalyst, the leading capital markets events and market intelligence company. For more information on DealCatalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.